Every day we have been getting more positive numbers from Europe. Today is no exception to that as well, and Troy actually even increases delivery estimates. That is certainly good news, and like I said yesterday, I think the consensus of 420,000 vehicles currently is underestimating what is going to happen, probably. We also just learned that Ford is losing about $22,000 for every single EV sold, while Tesla makes about $10,000 in net income for every EV sold, at least it did in 2022. Ford's margin sits at about negative 40%. Negative 40%. Specifically for EVs, of course. So now they will have to raise a lot of money to get through all this, to switch their business model to EVs during a time period when money is really expensive. I mean, Ford should have been on this list here, somewhere near Tesla. Ford is a big automaker, and yet it's transitioning so late. But they are transitioning, and now Ford is looking to achieve a global run rate of 600,000 vehicles, EV specifically, by the end of this year. And that is quite ambitious. And they want to get to 2 million by the end of 2026. Keep in mind, this year, Tesla will probably deliver about 2 million EVs. If you look at Tesla's earlier pace, Ford is actually trying to beat Tesla. If only Ford actually took Tesla seriously before, then maybe today Ford would be right next to Tesla right here, beating Volvo even in Sweden in terms of BEV sales, fully electric vehicle sales. Every day we are getting positive data from Europe. Hopefully that also translates to countries in Europe that do not report daily sales numbers, which is the majority of them, but usually or often they are correlated with each other. Ford projects losses from EVs at about $6 billion all the way from 2021 to 2023, and Ford expects to start making some profit before taxes before the end of 2026. I think this summarizes the whole situation very well. Tesla is mission driven. OEMs developing EVs are dragged, kicking, and screaming driven. No wonder it's been such a disaster. I'm sure someone is actually going to frame this. Yeah, he took the advice. Good job. Prasad actually did a great comparison between Ford and Tesla. Last year, Ford delivered 96,000 EVs. And Tesla, if you go back to a time when delivered a similar number, it was 101,000 vehicles, and Tesla had minus 20% margins. It's not an exact number because the way these numbers are calculated are slightly different, but it's a pretty good comparison. And Ford is now projecting that it will deliver 2 million vehicles 5 years later. Tesla ended up delivering 1.369 million, but Tesla has high margins. Ford is only aiming for 8%, and these are just projections, and projections are often, different from reality. Tesla promised years ago to deliver 500,000 vehicles in 2020, and that's exactly what Tesla did. That was despite supply chain issues, chip shortages, and all of these other problems. In the meantime, Ford experienced bigger losses, worse margins as it scaled up its electric vehicles. The margins are now negative 40.6%. This is how Ford is going to attempt to make money from EVs. They think that they will increase their margins by 20% from just making more vehicles. They think they will improve the design and engineering, and that will add 15% to the margins. They think they will save money with batteries as well eventually, and other little things as well, but they do anticipate more competition. I think they are probably underestimating this part. because Tesla will keep cutting prices. And what did Ford do? Then Tesla dropped prices. Ford also dropped prices and made its losses even bigger. I wonder what BYD's numbers are like. I mean, specifically EV numbers, just like Ford showed just now. I think BYD should also share these numbers. How is market reacting to Ford losing billions of dollars from EVs? Well, it was obvious already, so there's no reaction really. Because the market is not punishing Ford for sharing these numbers, I think this will turn out to have been a great move when we look back later. Because this, I think, will force Ford to focus more on these numbers going forward. Tesla has launched extended warranty options for the Model S, 3Y, and X in the US. Agreement period is 2 years or 25,000 more miles, whichever comes first. These are the prices for the warranty. However, it does have a lot of exclusions, and most importantly, the battery and the drive unit. So, yeah, I'm not really sure if it's really worth getting the warranty. Probably not. If a drive unit was included, and especially if a battery was included in that, yeah, definitely get it. Although, it may be worth it for the Model X, assuming that it does include all the things that could go wrong, the doors and everything. But for the Model 3, yeah, I don't think I'm gonna get that. We have known this for a while, but now this is sort of pretty much official that Tesla is expecting to lose the $7,500 tax credit for the Model 3 standard range. It appears that Tesla has communicated to employees that it expects the IRS to release the guidance any day now, and the automaker expects to lose the full credit on the Model 3 standard range, its cheapest vehicle. This is because the Model 3 uses batteries from China, specifically the LFP batteries, but no other model from Tesla should lose any benefits at all, as a lot of the batteries in other vehicles are from Nevada, for example. Gary, however, does not seem to be concerned at all about this. Model 3 standard range makes up only 21% of Tesla US volume and 9% overall global volume, so it's not really a big material impact to Tesla, says Gary. I mean, we will feel it a little bit, certainly, but it's not that huge. And mostly because I think Tesla is going to have a workaround of some sort relatively soon. Maybe batteries from another company, with a chance of that company being from South Korea. Perhaps Elon Musk spoke to the South Korean president before, and the president raised the question about a gigafactory in South Korea, but seems like Elon Musk was a lot more interested about the batteries specifically, and maybe he was trying to get some of these batteries so that Tesla can still keep getting the credit from the US government. Because if these batteries come from a country where the US has a free trade agreement with that country, then these batteries would make Tesla vehicles still eligible for these tax credits. And some will ask, how come Tesla did not work on that earlier? Well, I think Tesla thought that the 4680 batteries would scale sooner and quicker, but now we know that it's not scaling as fast, and so we have to rely on other batteries for now. And that is one reason why we don't have the long-range Model 3, because these would require batteries, for example, from Nevada that already go to the Model Y. The Model Y is a more profitable vehicle, so it makes more sense to allocate these batteries to the Model Y or to the performance Model 3 as an example. Also, I saw one pretty credible source say that it is quite possible that these $7,500 tax credits for the Model 3 could still be extended for 1 or 2 more months, although I'm not really sure if that would happen if it does end up not qualifying for the tax credit, but that's what that source said. We'll see what actually happens. Gary Black says here that many investors continue to argue against Tesla share buybacks and instead want more gigafactories. We would be thrilled if Tesla used its excess cash to build more gigafactories. We estimate the internal rate of return on building gigafactories is north of 70% versus 21% on buybacks, but that's not the choice. Gary continues that buybacks do not compete with operating investments like gigafactories. Buybacks are after funding all gigafactories, not girlfriends, and operating projects. The alternative to buybacks are number one, paying down debt, building cash, mergers and acquisitions, and dividends. We know that Tesla is going to be building another factory together with the factory in Mexico. So I wouldn't rush too much yet, especially with everything going on with our banking system. Maybe there is going to be a severe recession and maybe Tesla will need some of that cash. Although this is good news, Charles Schwab, the 10th largest bank in the US, says it has sufficient liquidity to cover 100% of bank deposits. So that's good, right? Charles Schwab, I think, is probably fine. I mean, the CEO bought more stock. And this right here is actually quite interesting, and I'm sort of confident I know what this means. She is leaving OpenAI's board, and she is also a mother of 2 of Elon's kids. I think this is a sign that Elon is building a competitor of OpenAI, I think. We'll find out soon. It will also be really interesting to see what Jerome Powell is going to do with the interest rates going forward. Maybe we will have just one more rate hike and maybe one more after that one. Well, we'll see. The market, though, thinks we will have rate cuts this year. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.